Good afternoon. George Cavaligos for HFT Bonds. Well, the game plan worked pretty well last night and early this morning. It's a little trickier now. I don't know if you guys noticed, but when we came in this morning, volume was very light. And from what I can tell from the people that I talked to on the floor and some of my old customers, a lot of the shops are starting to wind down for year end. And I think that's part of the problem now. We have a ton of supply coming. Started today with T-bills. Tomorrow we have a year bill auction and a 2-year note auction. Wednesday we have a 10-year note auction. It's also the FOMC meeting, and this FOMC meeting is a big deal, obviously. You know, what is the Fed going to do at the end of the year when Operation Twist expires? From what we've read in the papers, most of us seem to think that they're going to replace Operation Twist with, I don't know what they're going to call it, QE4, I guess, is the best thing to call it, where instead of buying bonds and selling the short-dated notes, they're just going to buy the bonds. And from what we've seen from the leaks from the Fed, it's going to probably be close to $45 billion, which is what they've been doing over Operation Twist. They've been buying $45 billion a month in long-dated bonds and notes and selling $45 billion in short-dated notes. Well, they're running out of short-dated notes. They don't have many left. So Operation Twist has to expire. They can't keep doing it because they just don't have any more short-dated notes left. So what are they going to do? You know, more QE seems to be the answer. It's, what's that old definition of insanity? Doing the same thing over and over again and expecting a different result. And they're going to do it. I think, you know, 45 billion is the number that's been tossed around a lot. Even though, and I'm going to put this out there, Fed Governor Bullard, who's kind of one of the more hawkish guys and is a voting member in January, said they should only do 25 billion of buying new bonds. And he also kind of threw out the idea of doing like an Operation Twist Part 2, where they would do in mortgages, buy long-dated mortgages and sell short-dated mortgages. I don't think that's going to work. I think they're going to do the 45 billion, but there is the, you know, idea out there that they could do less. I think the market's priced for 45 billion. If they do less, the market's going to get hit. I think if they do the 45 billion, we'll get some kind of knee-jerk rally on Wednesday when it comes out, but it won't be sustainable, I don't think. I think it'll just kind of keep us in this range. Look at that Treasury calendar. I posted the link in the chat room today. I should have put it in the email, but you can go to treasury.gov and find their schedule. There is an auction every day for the next 2 weeks, except for this Friday and next Friday. Whether it's T-bills, year bills, coupons of various maturities. Tomorrow's the, what? 3-year, not 2-year. I said 2-year earlier, sorry. Tomorrow's the 3-year. 10-year on Wednesday, 30-year on Thursday. Next week we go 2s, 5s, and 7s, along with a lot more T-bills. And a lot of the shops are shutting down. I don't know if the demand is going to remain the same. That's one of the big concerns I have. There's been a decent demand for all these Treasury auctions lately. You know, the flight to quality stuff, the game that we've been playing where you buy it in the auction, you turn around and sell it to the Fed. You know, whatever reason, there's been good buyers on these dips. I'm just a little bit concerned about tomorrow. I'd like to see some more dealer hedging. I don't think the volume was very heavy today. I think they did hedge some of the stuff that they're getting ready to buy over the next week and a half. I just don't think they hedged enough. I think the market can test the lows that we saw previously, that 133.0809 area and that 149.0103 area. We'll see what happens from there. So instead of buying the dip tonight, I think I want to sell the rally. I'm going to do it small. We had a great night and a good day today. I don't want to mess it up by going against the pattern here. And it's been a good pattern. It's worked for the last week and a half or whatever. I don't want to mess it up. So I'm going to try a small short tonight on a bounce. Take a look at the 133.23 level. And I threw up in the chat room 149.2830 area in the bonds. But I'm thinking the bonds might not get that high. Because I think we saw a good chunk of hedging in the 10-year today. I don't think we saw that much in the bonds. We saw some, obviously, and I think we need to see some more. That's why I think the markets are a little vulnerable here, more on the downside, and I'm kind of not leaning on a tips POMO buyback tomorrow of only $1 billion, $1.5 billion. That's not that big. That's small. So I'm thinking the bounce tomorrow morning and that a buyback isn't going to be that big. And if it is, you know, a bounce, I'll give it a shot on the sell side. The other thing I talked about, I threw in the chat room, was some of these leadership stocks were kind of looking a little laggish here. Now, obviously, Apple's been the headline thing, but I've been watching Amazon and Home Depot and IBM a bit more because they've been trading real strong, and they kind of lagged a little bit today. So I'm a little nervous. So I'm going to try a small, tiny short with a tight stop. I don't want to risk too much on this. We had a great night and a good morning. I don't want to give a lot of that back on, you know, whatever tomorrow's going to bring. On the other hand, if you don't want to try the short side, keep an eye out for the break. If we go back down and test those support levels that I think need to be tested, 133.08 plus to 09 plus and 149.0103, maybe you try to buy it down there. If we get there tonight, I'll even take a look at that, you know, as a spot to put on a small long. I'd love to see some more selling. I think the dealers need to get set up here. There's a lot of paper coming due, or, you know, to market here that they have to bid on. You know, you guys understand that dealers, primary dealers here in the United States, they have to buy these auctions. They can't just say, I don't like it, I don't want it. They have to buy. And that's part of their deal of being a primary dealer. So they hedge, and it's smart. They don't want to take a loss on this thing. They want to buy them from the Fed. They want to turn around and sell them to the customers and be done with it and make hopefully the bid-ask spread or whatever little portion they can make on it. So that's the game plan. The wave count still looks, you know, pretty negative here. Again, I want to see what happens when we test those lows. That might set up for a better bounce at that point. And then what do we do with the Fed? That's going to be the big, you know, kahuna trade. I don't know which way to go with it right now. We'll take a look at it tomorrow late in the day. We'll see how much of the dealer hedging we've seen go through the market, and we'll have a better idea of which way the market's leaning now in terms of supply and the Fed. I'd hate to be a bond dealer and have to buy the 10-year right after the Fed comes out with its announcement. Dodgy, scary stuff. Have a great night, guys. See you tomorrow.